Welcome to the Money Tips No One Told You podcast. I'm Heather with First Pioneers Federal Credit Union, and I'll be your host. At First Pioneers, we're dedicated to caring for our members' financial needs with heart, and that means providing more than just financial services. It's about empowering you to take control of your financial destiny through knowledge and understanding. This podcast is all about guiding our listeners toward a brighter financial future. So get ready to embark on a journey towards financial well-being, because at First Pioneers, we believe that when our members are financially successful, we all succeed. Stay tuned for a wealth of knowledge and inspiration. Do you ever listen to commercials or see an ad, or maybe you even go to your credit union or your bank and they say things that just really don't make sense to you? Or maybe you kind of know, you've heard enough that you understand the concept, in context, you understand what it means, but you don't really get it. Today, I want to talk about 10 financial terms that seem to just often confuse us typical consumers. And hopefully, by the end of this episode, you'll have a clearer understanding of these terms and how they impact your financial life. First up, we have APR and APY. And I'm sure you guys have heard these before, but maybe not, you may not really realize the difference. So APR is annual percentage rate, and an APR is the annual rate that's charged for borrowing money. So this is going to include the fees or additional costs that are associated with this transaction. So it's a little bit broader than just the interest rate, because it's going to include those fees or really any other cost in obtaining the loan. Next, we have APY, which is annual percentage yield. And often people confuse that with an APR, but they're not the same. Okay, so here's the definition of APY. APY is a percentage that represents the amount of interest an account earns in 1 year, including compound interest. APY is a more accurate way to measure an investment's return than simple interest rates, because it takes into account how often interest is compounded. When interest is compounded, it's added back to the balance, and future interest is calculated based on the new amount. Okay, I think that made sense. So now here's what it means. An APY is only used for accounts that pay you money, like a savings account, a money market account, CD. Now, it's important to note that the APY's accuracy depends on the account owner, and that's you, not withdrawing or adding any money to this account we're talking about during the year. Okay? So hopefully that makes sense. So, an APY is the rate that you earn interest or money. An APR is the rate that you pay interest or money. So essentially, APY is going to be savings investings, APR loans. Okay? All right. So now on to number 2, which is principal. So the principal is the original amount of money that you invest or that you borrow when you're talking about a loan. So this is the amount before any interest or any earnings are added. Okay, for example, if you deposit $1,000 in a savings account, that $1,000 is your principal. Anything else is money that you've earned, right? Same for a loan. If you're buying a car and the amount that you borrow is $20,000, you borrowed $20,000, that's your principal. Anything else is the interest or whatever that's added to that amount. Okay, so the principal is the original amount of your deposit or of your loan. So let's move on to number 3 and talk about this interest a little bit. For a loan, the interest is basically the cost of borrowing the money. Typically, it's going to be a percentage of the principal. And like we said before, the principal is the amount that you borrow. So interest is the amount you pay to borrow that money. And in our example, you would pay a percentage of $20,000, and the percentage depends on the term of your loan. And that's going to vary depending on many, many things. Where you go to get the loan, your credit, all those things. So the percentage is going to vary depending on where you are, type of loan, all that. But you know that you're going to pay that percentage on the amount that you borrowed, which again in our example is $20,000. And it's similar for savings. Whatever you put in an account, let's say it's CD, you will earn interest on the amount you put into the account. And it depends on the rate at that time, at the credit union or at the bank, how much that interest is. But the percentage is on the principal that you deposited. So now let's take that one step further. There are two main types of interest: simple and compound. Simple interest is calculated only on that principal amount. Okay, that base amount we talked about. So if you borrowed $1,000 with simple interest, you pay interest on $1,000. For a savings account, if you deposit $1,000 and that balance remains the same, then you earn on that $1,000. Compound interest is admittedly a little more challenging to understand at times. So the definition: compound interest is the interest on a loan or deposit that is calculated based on both the initial principal amount and the accumulated interest from previous periods. Okay, so let me see if I can simplify that a little bit. I'll start with the savings account. Compound interest would be calculated on the principal plus any interest that you already earned. So basically it's interest on interest. So you earn money on what you deposited or your principal. Remember we said that before. Then any interest you earn is added to your balance. So you had your balance of $1,000. You earn interest. That amount is added to your balance. Then you will earn interest on that total amount. So as that balance increases, you earn interest on it. So you're earning interest on that increased amount. And it can actually significantly increase the amount of money that you earn over time if you continue to let that build. Okay? Now let's move on to loans. And many loans are typically a simple interest. Okay, it's a payment that's set. You've purchased the car and you're going to pay it back over a set amount of time. So therefore you're going to have set payments. And we're actually going to talk about that in just a second, to elaborate on that in just a little bit. Something like a credit card, or even some mortgages are like this, are ones that may use compound interest. And an easy example, those are credit card, especially if you're carrying a balance on that card. Okay, so let's say you charge $500 on your credit card. You're going to be charged interest on that amount. All right, let's say 10% interest. So on $500, that's $50, right? So you charged $500, you got charged 10% interest. So now you owe $550. Okay, that's the cost of using the card services, right? That's the cost of borrowing the money, because even though it's called a credit card, you're borrowing money in order to buy something. Okay, now let's say you only pay part of that balance when the bill comes. Let's say you pay $100. Okay, that leaves you with a balance of $450. Next month, when the bill comes, you owe that balance plus the interest on that balance. Okay, so for this example, that was $450. Again, at 10% interest, that's $45. So now you're going to add $45 to that balance of $450. The new balance you owe is $495. If you made any new charges during that time, then the interest that you owe for that month is going to be included on those charges as well, new balance and old balance. So your interest that you owe is compounding because you owe interest on the money the first time you charged it, and now, well, it's still there. You still owe a balance, so you still owe interest on it. So it just keeps adding up. So just like it adds up for savings, it also can add up on the loan side too. That's why often you'll hear us say, pay your credit card balances each month if you can, or at the very least, keep those balances low, because that interest it's insane. And 10% is not what you're normally going to find. A lot of places have variable interest rates, and cards have 30% interest rates. So it's an insane amount of money. And that's often the reason you struggle to get ahead if you have a balance on your credit card, because you're just constantly paying the interest. You're never really touching the balance. So just something to think about when you're paying it off. But hopefully that helps you understand how that compound interest works. Now at number 4, we have amortization. That's a big word, right? And you may not hear that often, but it's a good term to be familiar with. This term refers to the process of spreading out a loan into a series of fixed payments over time. So this would be for a loan that's a set amount, like we said before, like for a car. So when you look at your payment schedule for your loan, each payment goes towards both principal and interest. Okay. So in the beginning, when you look at that, a larger portion of your payment is going towards the interest. But as time goes on, more of it will go towards the principal as you pay down the loan. Because basically, the interest is less as you go because the principal balance is less. So your payment is a set amount each month, but less interest is being charged to you because you're paying down on that principal amount. Therefore, less interest is owed. So more goes towards the principal. And of course, this is with the simple interest example that we talked about earlier. Let's continue a bit with the talk about loans with credit score and credit report at number 5. And credit, it's always just such a big topic. I feel like everywhere I go, something about credit is a question I get asked. And it feels like credit score is the main concern for many people. And it's important. Okay, hear me. A credit score is important because it can determine so many things. But a credit score and a credit report are different things, and they're both important. Okay. So a credit score is a number that represents your credit worthiness, okay, or how likely you are to repay a loan. And it's based on your credit history, including how much debt you have, how long you've had credit, whether you pay your bills on time, things like that. And like we said, of course, the higher your score, often the better rates that you can qualify for. So that's where the credit score comes from. But your credit report, that's basically where all this information comes from for them to determine the score. That's where you see balances or any issues you've had with your credit, like collections or any errors. Errors may be as simple as an incorrect mailing address. So error may not really be a big deal, but it would help if it was corrected. So we actually recommend that you check your credit report at least once a year, and that can help you spot any issues or any things that are wrong, even any signs of identity theft. You would see those early. Now, of course, you're actually entitled to a free credit report from each of the 3 major credit bureaus, and you can get one every 12 months from them. And these are the people that report information so that it's on your report. That's going to be Equifax, Experian, and TransUnion. And we can put that in the show notes. You can find it. And again, you can get a free report from them every 12 months. And they are going to vary a little bit. Each one kind of reports a little differently. So one score may not be the same as another. And a lot of creditors are going to look at probably all three and kind of get an average to determine what your score is. There are other places you can also get a report as well. For instance, freecreditreport.com. They'll give you a report free once a year. And of course, keep in mind, this is the report, okay? That's not the score, but this is giving you the information that's reported for your credit. But this is actually important. Staying on top of your credit report can actually help ensure that your credit score is accurately reflecting your financial habits and your financial behaviors. So taking a look at that report, if there's any errors, if there's anything that needs to be handled, then you can get those corrected, take quick action so that the report is accurate and therefore your score is reflected accurately. So something to keep in mind. Next, let's talk about equity. I actually hear this come up a lot because people will talk about equity and how you can use equity, but I think some people don't truly understand what equity is. And again, you're going to hear that a lot, especially with homeowners, because they may want to sell, or they may be looking for a second mortgage or a line of credit or something like that. And that's when this equity is really going to come into play for them. But basically, equity refers to the ownership of assets that may have debts or other liabilities attached to them. So for the homeowners we mentioned, equity is going to be the difference between the market value of a property and the amount that's still owed on its mortgage. So your home may be worth, let's say, $200,000, and you still owe $100,000. In that instance, you would have $100,000 in equity in your home. So while it can help for the loans that we mentioned, it's also important to build equity because that represents the portion of the property that you truly own, and that can be important. Another term that often causes confusion is liquidity. Liquidity is the ease with which an asset can be converted into cash without affecting its market price. Because, almost everything has a price based on how the market looks, like your home. So highly liquid assets are going to be things like cash or stocks, but because those can be sold quickly. Whereas assets like real estate, so your home or maybe a rental property or land, those are considered a little less liquid because they can just often take longer to sell. At number 8, let's talk about net worth. I feel like people think they don't have a net worth unless they're really wealthy, but that's actually not necessarily the case. Net worth is basically the total value of your assets minus your liabilities. And it gives you a snapshot of your overall financial health. For instance, if you have $100,000 in assets and $40,000 in liabilities, then your net worth is $60,000. So you might actually have more than you think. Now let's move on to diversification, and this is dealing with your investments. So when you plan your investments, one of the things you look at is risk. And if you're working with a financial advisor, they're going to most likely discuss a risk management strategy with you. So how much risk do you want to take with your investments? Because big risk is a double-edged sword, right? It can have big return, but it can also risk big loss. So maybe you invest safer to not risk losing as much. A mix of investments within a portfolio is called diversification. So to clarify, your portfolio is all your investments. So your portfolio may be made up of several different investments. The idea that a diversified overall portfolio will, on average, yield higher returns, but pose a lower risk than any individual investment found within one portfolio. So this mix it balances it out, if that makes sense. A few higher risk, a few lower risk, maybe a few in the middle. So hopefully you don't see huge losses, but you're still making good gains. So that's why you want diversification if you can. And finally, we have yield. Yield refers to the income that's generated by an investment, such as interest or dividends. And this is expressed as a percentage of the investment's cost or current market value. So it provides a snapshot of the income you can expect from an investment over a specific period of time. And that's typically going to be on an annual basis. And while we're at it, let's talk about return, because if you're dealing with investments, you've probably heard both. Yield and return are both measures of an investment's performance, but they focus on different aspects. So return encompasses the total gain or loss on an investment. So it will include both the income or the yield and any change in the investment's value, known as capital gains or losses. So while yield focuses solely on the income component, return gives a more sort of comprehensive view of an investment's performance because it accounts for the overall increase or decrease in value over time. So understanding both of these can be truly beneficial when you're evaluating the performance of your investments. Okay, I know that was a lot, huh? I encourage you to go back to sections that you really wanted to focus on or to understand if you need to. Maybe just go back and re-listen to that part, maybe make a little note. Because, of course, as always, if you have questions, feel free to contact us here at First Pioneers. We're happy to help with that. And maybe if there's something that, I want a little more explanation or something, maybe just make a note and then let us know. And of course, before we go, I have a bonus for you. And given the times we are in, I feel like it's really important. I want to talk about inflation, recession, and I even want to touch a little bit on depression. I mean, we're living with inflation, right? And we have been for quite some time now. And I'm hearing a lot of talk about a recession, and I've even heard a few people say the word depression. I don't know how likely that really is. But I want to discuss it because I feel like some people may not fully understand what these are and the differences in them. So let's start with inflation. Inflation is the rate at which the general level of prices for goods and services is rising. And subsequently, the purchasing power of currency is falling. And we've all seen that, and we're experiencing it right now. But I also want to explain a bit about the percentages you hear reported. They'll say that inflation has slowed, but unless they say it has stopped or reversed, then it still exists. If they say the percentage is lower, that doesn't mean inflation went down. Okay, it simply means that it didn't rise at as high a rate as it had the previous month. So it's still an increase, but the percentage may fluctuate a little bit from month to month. Okay, I'm going to give you just a little bit more information on inflation. Inflation can sometimes be difficult to understand when you start putting all of the economic things behind it. So the Federal Reserve says they would like to see inflation at 2%. This is why we saw rates increase recently. You saw the Fed raised interest rates. They did that in an attempt to slow the spending habits of consumers when they raised those interest rates on loans and whatnot. Because as consumers slow their spending, the demand, therefore the price for items, would go down. This is why you see things go on sale. Companies put an item on sale, hopefully to encourage people to buy. Okay, that's called a monetary policy. We've actually gotten into some of this in a different episode as well, if you want to go back to that. But that may give you an idea as to why the feds adjust the rates. They're trying to help adjust spending and therefore help the economy. And I know that goes pretty far into economics, and I don't want to do that to you in this episode, but I at least wanted to touch on it. Like I said, check out that other episode if you're interested. But that's why sometimes you do see things with inflation adjust, and why people talk so much about the feds and the rates, because they're adjusting those rates, attempting to maybe slow or speed up spending and whatnot. So that's why you've seen that talked about so much these days. Often issues in the economy with things like inflation and people's ability to spend or borrow and such can bring up another term, and that's recession. Now, a recession is when we see a significant decline in economic activity spread across the economy, and that generally lasts for more than a few months. You see it in the GDP, prices, income, employment, industrial production, and also wholesale and retail sales. It's truly across the board. And a recession can impact jobs, investments, and just overall economic stability. Oh, and real quick, I said GDP. Some people don't know. Big word again. GDP stands for gross domestic product. And this is the total market value of all the finished goods and services produced within a country's borders in a specific time. That was a lot to say, wasn't it? It's a broad measure of basically overall domestic production. So it functions as kind of a comprehensive scorecard of a given country's economic health. So I hope that makes sense. Obviously, these terms can be difficult to understand. That's the reason we're here, right? So the gross domestic product has to do with market value. Okay, so a recession is different than a depression, and truthfully, they happen a bit cyclically. If you look back through the years and look at the economy, you will on occasion see a recession. You see the economy drop into a recession, and then you see it come out. So there tends to be a cycle in that. But lastly, I do want to talk about a depression. People hear depression and they get nervous, as well they should. A depression is not a good thing. So depression is a prolonged and severe downturn in economic activity. It's characterized by significant declines in the GDP that we just talked about, widespread unemployment, a sharp drop in consumer spending and business investment, as well as deflation. Okay, so the opposite, low inflation. Everything starts to come back down. So unlike a recession, which is typically shorter and less severe, a depression usually lasts for several years, and it can lead to truly widespread business failures, bank closures, a severe contraction in the overall economy. Now, the most well-known example that a lot of us may know about, the younger kids may not be as aware, but they've probably learned about it in school, was the Great Depression, which began in 1929, and it actually lasted until 1939. And it had a profound global economic and social impacts, as a depression will. Look, hopefully this is not something that's in our future, but it is something that is probably being brought up as part of economic discussions, as well it should be, because that is something to be aware of and to know. So a lot of these economists, it does come up in those conversations at times. So my recommendation is basically keep yourself as informed as you can, pay attention to what's going on, do what you can to make yourself financially healthy, which you want to do that anyway, but that will help you as we go through these ebbs and flows of our economic situations. And of course, that's going to include, if you have any questions, ask any questions that you need to. We're always here to help in any way that we can. So there you have it, the top 10 financial terms that often confuse consumers, plus a little extra. I hope this episode has helped clarify some of these concepts for you, and that it can help you on your financial journey to financial success. That wraps up another episode of Money Tips No One Told You. We hope you enjoyed the insights and tips shared today. If you have any questions, thoughts, or topics you'd like us to cover in future episodes, feel free to reach out. If you found value in today's episode, don't forget to subscribe, rate, and leave a review. Your feedback helps us tailor future content to better serve you. There are several ways you can find us if you need further information or need to speak with a financial counselor. Visit us in person in Lafayette or New Iberia, Louisiana, or at firstpioneers.com to find out how to become a member of our family and find other financial information. Also, be sure and check out the show notes for important links and important information. Your financial journey is important to us, and we're here to support you every step of the way. We hope you have a great day, and we'll see you next time.